Hey guys, thanks for clicking on this video. Today we are looking at Roku Inc., ticker symbol Roku, and we're going to see if this is still a buy in 2021. We're going to be talking about what this company does, some big investors in this company, and then going to look at the fundamentals to give my fair value based on discounted free cash flow and the Buffett-Graham intrinsic value. But you can see Roku is currently at $206 a share, and if this is the year chart, if you see where it was in August, it was over double this at 480, which is about its all-time high, and basically this has lost all of its gains for the last year. So is this still a buy in 2021? That is the question we are going to answer today. But first, what is Roku? Well, it is a company which provides a variety of digital media players for video streaming. They have their players, they have their TV, they have their audio, and you can stream basically anything here: Netflix, Disney Plus. This is the UK version, but Prime Video and their own, obviously, Roku channels. So that is what the company does. But who are some major investors in this company? Well, everybody's favorite, Cathie Wood in the ARK ETF. You can see here that Roku Inc. is actually her fifth biggest holding, with almost $1 billion of market value, 5% of her total holding, more than Shopify, more than Square Inc., more than Palantir, Twitter, only below Zoom, Teladoc, I don't know what that is, Coinbase, and Tesla. So one of her largest holdings. She's been buying into it, but as you can see, the stock price has been hammered over the last year. So is this still a buy? Well, let's have a look at the fundamentals. Currently, Roku has a market cap of $28 billion. And it has a share price of $207 a share, 52-week low of 204, and a 52-week high of 490. So will it get back up to that 490? Let's find out. So the dividend, they do not pay a dividend, and let's get into it. Is the P ratio less than the market? No, the P ratio is 99.5 compared to 28.5. So that is a big fat fail. But we know Cathie Wood likes stocks that don't necessarily make a lot of money now. It is the potential future growth that she is interested in. So that's why we're going to be looking at the Buffett-Graham value to see what they think. Next, is the revenue increasing? Yes, it is. Revenue has gone up almost $2.75 billion to $2.5 billion. So that is a massive pass, very fast growing. Is the profit growing? Yes, profitable company was minus $8 million and is now $280 million in the profit, which is excellent to see. So the profit is increasing. But are their shares outstanding increasing? No, they're not. Went from 28 million to 124 million. That is a massive, massive increase. Really diluted shareholders there. But this is quite common in these type of fast-growing companies who are relatively young. I mean, it has been around since 2002, but it's really only been on the scene since the IPO in 2017. Now, is the free cash flow increasing? We hope to see yes, minus 4 million to 266 million. So that is 3 passes and 2 fails with a free cash flow ratio, which is 27 billion in market cap divided by 276, which is 104, very in line with the PE ratio that has now even crossed the 100 barrier as we've been doing this video. So looking pretty high. I don't think discounted free cash flow is going to like this stock, but let's have a look anyway. So I've calculated the future free cash flows. Not too bullish, as you can see here. We're going to put in a couple of estimations here to see what the difference is, but this is basically kind of on fair estimations. And what does this do? Well, it would say the calculated stock price is around $86 a share, which means it's massively overvalued at the minute. So if we just quickly look at where $86 a share was, you would have had to go back to basically just before or after the initial pandemic drop. So that might be a bit too low. But if we just go look at the numbers here and make them a little bit more bullish, we want to see that free cash flow increasing. Let's just say it increases a little bit more, which is about where the jump has been. It continues at that. Even then, still $138, which would mean it's still overvalued at the minute. But the interesting thing about this stock is we're looking at the Buffett-Graham intrinsic value, where expected growth rate is taken into account, and the expected growth rate of this company is 49% over the next 5 years. So let's see what that says. With an earnings per share of $2.07 a share, let's see what that gives us. And interestingly enough, it says it is about fairly valued at the minute, $220 a share, which means it's at a 6% discount and a Graham price, which is a buy and hold. If you wanted to buy this stock and hold it for a long time, you'll buy it at 165. So 220 is about fairly valued. So I'm quite surprised at that. A lot of people think these stocks are overvalued. But with that expected growth rate of 49%, the Buffett-Graham intrinsic value does like this stock. Now, it was definitely overvalued at these previous points, but is the stock going to find some resistance here? This was a previous resistance point. So I'm surprised at that, to be perfectly honest, but it is good to see that this is why we look at multiple models. You don't want to look at discounted free cash flow for stocks like this because you can get a different side of the coin here. Do analysts agree with us? No, they do not. Analysts are saying that this stock is a $400 stock. On the high side, $550, and on the low side, $220. So this is what the stock price will be in a year. Analysts are very bullish on this stock. So the 400 and 500 would basically take it to its all-time highs once again. So analysts are expecting a pretty big turnaround soon. We've looked at the models and we would have to disagree, but once again, I'm just bringing you the information here. Next, what we want to do is look at some technical analysis. We have the moving averages here. We have a 50-day in green, a 100-day in yellow, and a 200-day in red. And what we can see here is massive bearish signs. The price is below all of the major moving averages. You can see death crosses all the way here, and then the shorter moving averages crossing, and then finally the yellow has crossed across the red, which is the 100 over the 200. So moving averages is basically saying stay the heck away from this stock right now. Very, very bearish signals. If you do look at if it does consolidate again, you can see the 200 was acting as a bit of support, but this was on a massive climb. So moving averages aren't really telling a good story about this stock at all. So let's move on to the next thing, which I like to look at is the MACD. So once again, you can see here, if you were to buy this stock or sell this stock here, you would have seen that the MACD line, the signal line's crossed, and it is very bearish here. So what am I seeing that's bearish? Well, firstly, the MACD and signal line have crossed on the negative side. This is displayed by the red histogram, and also these lines are way below zero as well. In fact, probably the lowest they've been basically since, well, a long time actually, since the entirety of this year and a bit of the previous year. So MACD is also staying away, but if these lines do cross, then you could expect some good movement. It looks like they're starting to come closer, but once again, MACD is also saying that the stock is not a buy. The final piece I want to look at is the RSI, Relative Strength Index, and right now this stock is we're looking at the daily chart here, we'll look at the weekly next. This stock is in oversold regions. So if we look at the daily and try and zoom out a little bit here, this is the lowest it's been basically up until the pandemic, where the stock did have a rally since then. So that is a bit of more of a positive sign, is that it is at regions it has never been before. And when it has hit these regions, you can see here and here, the stock has made some movements to the upside. Not so recently in this previous run. And then if we look at the weekly as well, this is from the, and you can see basically this is the lowest it's ever been. When it has been this low again on the weeklies, it has made a move up here in December of 18, here in the pandemic, and here again. So overall, the technicals are pretty bearish, but the RSI is saying that basically the stock has never really been this low, but this is following this massive high. So just a quick recap. Discounted free cash flow does not like the stock at all, even on the more bullish estimates, $140. Buffer Graham intrinsic value says it is a buy, but it's only about fairly valued. And the analysts basically love the stock, and obviously so does Kathy Wood, because it is her third largest holding. Right, guys, thanks for watching the video. Please give a like if you've enjoyed it. Give a comment your thoughts down below on Roku, and I'll catch you guys next time.